With respect to business valuations, a couple of concepts that come into play is typically most business valuators will use three methodologies: an asset approach, an income approach, and a sales approach. They'll use all three to kind of spot check their results to see which approach is the best. And usually they'll pick one of the three, but typically most valuators will do all three. Now, in terms of a business valuation, once you come up with a number for what the business is worth, that number is subject to potentially some discounts. You could have a discount for lack of marketability, because it's harder to sell a mom and pop store than it is readily of trading a share of Exxon on the stock market. And so a business valuation person, in terms of looking at, may say the business needs to be discounted 20% because it may take 2 years to sell the company. Another concept would be lack of control, for example. If you're just a 40% owner of a company, that's not as valuable as buying the entire asset. So some valuators will give you a discount for lack of control. Most business valuators are going to want 5 years worth of records. They're going to want bank statements for the business. They're going to want essentially financial records such as income statements, balance sheet. They'll usually want those going back 5 years as well. So they can look at historically how the business is done and try to project how it's going to do in the future.